We're going to go from bat bone marrow to interest rates. So it's a kind of hard pivot here, but I find all that stuff fascinating.
So do I.
So Roger Ferguson, former vice chair of the Federal Reserve, former chief executive of TIAA, welcome to at Barrons. It's great to see you. Thanks so much for coming.
Andy, nice to be here with you in this audience. I'm looking forward to it.
So it's really fortuitous that we have Roger here today as our guest because, of course, the Federal Reserve just made a momentous decision about interest rates just a few days ago, widely predicted, of course, but still a pivot moment. Am I overstating it? Am I mischaracterizing it? What do you think about the Fed move last week, Roger?
Well, obviously it was a pivot, right? It was the first time they've cut rates in many years. Point two, it was certainly, as you say, telegraphed that it was coming. Chair Powell gave a speech at Jackson Hole that basically said it's about time to make the move. Having said that, there was some drama. 50 basis points, 25 basis points, a sort of close call. At the end, as you saw, they did 50 basis points, and I thought Chair Powell did a good job of laying out the rationale in a way that was very calm. So pivot moment, momentous because it was the first move, but I'd say executed very well.
You've known Jay Powell. You just told me you guys were, was it first-year associates at Davis Polk? That was probably a few decades ago, right?
Well, in his case it was. Yeah, for me it was just like 4 years ago. Yeah, so we were first-year associates together literally back in 1981. So I've known him for a little while.
Tell me what kind of a guy he is and what is his thought process?
Well, look, what you see is what you get. So, a lawyer, as with any good lawyer, very driven by facts, as he should be. And you see it here, right, where it's a discussion of being very, quote, data dependent, not data point dependent, but data dependent. That's basically the incoming facts will help to decide what the policy is. There are a number of people who have done that job. I've known many of them who are much more driven by, their particular model of the economy. Chair Powell is very much, give me the basic facts. Secondly, as I think you saw, as with any good lawyer, I hope he comes across as a very good communicator. He's laying out his argument very well. You can agree or disagree with it, but you certainly sort of understand, what's going on. I think the third thing that has become more and more visible is he is really quite good, again, as any good lawyer would be, at building sort of a consensus. The Fed has had many different kinds of leaders. I've known many of them. I would say I put him very much in the category of one who listens closely to his colleagues, tries to figure out what the middle ground is, and sort of brings them along, very neatly. And that's, those are really very, very important traits, particularly when you're dealing with, the range of issues that the Fed has been dealing with in the last several years.
Were you surprised by 50 basis points versus 25 basis points, and what would you have recommended?
I was not surprised in the sense that both were on the table. And I've said this publicly, I probably would have gone more for the 25 basis point. What I found very interesting is that Chair Powell laid out the rationale I had for 25 basis points, but plugged that into a 50 basis point decision, which shows what an incredibly good, communicator he is. So the reason I thought 25 basis points was fine, which is not to say, objected to 50 basis points, but he made a number of points that are really relevant, right? The economy is actually in very good shape. That struck me as well, probably more 25 basis points.
Yeah.
Inflation is certainly, coming down, but is not yet, in my mind, without some risk. There are one or two elements that are still fairly sticky. But having said all of that, at the end of the day, the real issue is the pace and where they end up. It's not do they start with 25 or 50. And so I always remind people, while it's exciting in some ways, it is only 25 basis points. And the real issue is, where are they going to go and where do they end up? And that, I think, is yet to be decided. So, I give them 2 thumbs up on executing this pivot, very masterfully.
The cynics might ask, or Monday morning quarterbacks, 2 points. One, the Fed's been accused of being late. So is this a way of, I'm not going to be late this time, number one. Number two, would it suggest perhaps that the economy is weaker than we might think?
So I don't think it suggests the economy is weaker than we might think. However, they've clearly pointed out that, they don't want to see the labor market getting significantly weaker. So, in the world of the dual mandate, the attention has moved somewhat to a more balanced risk, as opposed to it's all about inflation. Now it's inflation and also unemployment. On the question of being late, I thought he said something that was very, very clear about that, which is, one, he wanted to get off to a fast start, and two, I think I'm quoting him directly, we don't want to fall behind. So one might interpret that as, well, they've learned a lesson and know they don't want to be late going forward. I wouldn't criticize him at all for saying, gee, we've learned a lesson and we want to avoid making that kind of mistake. After all, presumably, all of us hopefully learn lessons and continue to grow and evolve. So don't, criticize the central bank for doing the same thing.
What do you anticipate for the balance of the year, Roger, and for 2025 in terms of rate cuts or interest rate policy going forward? James McIntosh, my colleague of the Wall Street Journal, wrote today that 50 basis points is the new 25 basis points.
Well,
certainly that story.
Yes, I don't think that 50 basis points is the new 25. I see no reason to imagine that's the case. I do expect, because they've said it, that they will continue to cut rates this year. For those who are into the Fed speak, there are so-called dot plots, or the summary of economic projections. So, every other meeting they put out, what they expect to happen. It's not a forecast. But the expectations, assuming things unfold as they expect, would be, another couple of 25 basis point cuts this year, so down a total of 1%, and then, a continuation of cuts into the new year. Importantly, conditioned on the economy unfolding as currently expected. And the other thing that was very interesting is when one looked at, where the committee, the 19 members of the committee, thought they might end up, there's a pretty wide dispersion. And so I think, from my standpoint, observing what's going on, it wasn't 25 or 50 at the start. As I said, it's where they likely end up. And they're really undecided. Across the 19, a pretty wide dispersion of what we would, in economics, would call the so-called terminal rate. And so I think there will be, much more for people like you and your colleagues to report on, out of every Fed meeting as we get excited about 25 or 50, but more importantly, where exactly are we going to end up? And, that chapter has not been written yet because the economy is still unfolding, obviously.
Yeah, I want to sort of talk about that endpoint, because it's sort of this weird paradox. I mean, there never really is an endpoint, right? Like, soft landing to what? We've been talking about a soft landing for years now, right?
Well, so yes, you're obviously right. There's never an endpoint. Fortunately, the economy just doesn't stop, which is, trust me, good for all of you.
Yeah.
And certainly good for me in my incarnation in the investment business. There is an endpoint in the following sense. For long periods of time, inflation has been relatively quiescent. And so we hope to go back to a stage where inflation is relatively quiescent. This crisis that we just had was fairly unusual for the last 20-some years. Similarly, if the economy grows at its potential, we hope to keep unemployment roughly at a state of full employment. And when that happens, you go through long periods where the Fed doesn't move interest rates whatsoever. So I think, what we're all looking for is the so-called soft landing, is a period in which the economy appears to be growing at or close to potential. Unemployment seems to be close to what we think of historically as full employment. And the Fed is not forced to be moving interest rates, up and down every meeting. What that looks like right now, we don't know. And very importantly, among policymakers, but I'd say among the economics profession and among people in the business world, there's a big question of what all this looks like, in part because the shock of the pandemic, a short, sharp recession, a big bounce back, and we don't know things like how many people are likely to be in the labor force, and what's the impact of some of these newer technologies, and is there a reason to think that the disinflationary pressures of the last few years are going to reverse. So there are many big questions about what the soft landing looks like, what permanent, what the neutral rate looks like, et cetera.
Yeah, I was going to just you got right to it, that neutral rate. There's a lot, it's the R rate, it's sometimes called, which is the natural rate of interest rates, what it is or should be in this economy going forward, which speaks to how much inflation do we have now is permanent or not transitory, or at least will last for the next 5 to 10 years, something in the cycle. Like the disparity between the range in the rates from 2.4% to 3.8% is pretty large, right?
Yes, it is.
What do you think about that? I mean, so in other words, what we're really asking or getting at here is how much inflation is going to be with us for a while?
Well, let's start with the inflation target the Fed has, which, by the way, is shared in different formats by almost every central bank around the world. So we have an inflation target, let's call it 2%. They've made some slight adjustments, but one should think of almost all central banks aiming to get their individual national inflation rates at roughly 2%. And so, hoping for, wishing for, cheering on for success of my friends and former colleagues at the Fed, I'm hoping to get to a 2% inflation rate. What they don't know, and no one knows yet, is, well, what is the interest rate they have to set that will achieve that goal and maintain that goal? That interest rate that you just talked about is called R star, and it's sometimes called the neutral rate. It's the rate that neither stimulates nor retards the growth of the economy. And there's quite a bit of debate in academia and I think among policymakers as to what that looks like. If I can add one more sentence
Please.
to that.
Yeah.
Chair Powell said something that's really important, which is, I think to quote him, we'll know it by its works. So he is not hanging his hat on a particular hard and fast number around the so-called neutral rate. Being very data dependent and data driven, I think he's looking to see what is that rate that they can maintain that seems to keep inflation roughly at 2%? And time will tell.
Right. I mean, but what's your best guess, Roger, in terms of how much inflation is out there? Because initially it was supply chain from COVID and the Ukraine war, deglobalization. That's what's making prices go up, right?
Yeah. So look, well, let's start with the facts, which is inflation has in fact come down, depending on how one measures it, to 2.5%, by some measures even less, by some measures even more. So I don't need to guess. I can tell you right now what the inflation rate is. It's roughly 2.5%.
Fair enough.
I think you're asking a slightly different question, which is, perhaps you're asking, do I think they'll get to 2%? I certainly hope they will. The other side of your question may be that there are one or two parts of the economy that seem to have inflation that seems to be sticky well above the Fed's target, and that is particularly in the housing sector. The official measures of inflation have two different types of measures of housing inflation. One is rent, and one is a measure called owner's equivalent rent, which is an approximation. Both of those seem to be holding up inflation at well above a 2% level. So I think if you're asking how much inflation is out there, in the housing sector, it looks like it's pretty high. Yeah. In the sector called goods, which is things that, the goods, that number has come down quite significantly. And then in the general services sector, that number is still slightly above 2% or in the range of 2%. And so, there is some stickiness left.
Right.
But, and I am with them fingers crossed that they will achieve the soft landing and get overall inflation to roughly 2%.
And Americans are still shocked for the most part. I don't think that's too strong a word by inflation because so many people in our country just haven't experienced it.
Well, that was one of the major points I made, right? The last time we had, I graduated from college and started working, graduated from school and started working at about the same time as Paul Volcker was the chair of the Fed. That is the last time we had a really big outburst of inflation. And Volcker had to really throw the economy into a very stiff recession to wring that out. Since then, for a lot of reasons, including changes in the global economy, changes in the domestic economy, credibility at the Fed, mainly folks have experienced roughly a 2% inflation. And so, to your point, when it suddenly breaks out, people are shocked because we haven't experienced it. And what we discovered, something that I knew and I think we've all discovered, is that inflation is a terrible hidden tax, primarily on low and moderate income people. And you hear Chair Powell say that as he opens up his press conferences most often. He talks about that fact. And those are the folks who are suffering the results of not just a high inflation, but also a change in price level, and that doesn't reverse.
Right.
Remember, all inflation is doing is slowing down the rise in price level. It's not bringing prices back to the level of 2 or 3 years ago.
Right. Price of eggs is still, yeah.
It's still whatever it is.
I know you're a student of history. So what's abnormal? A lot of inflation? No inflation? A little inflation?
Well, look, so what's been abnormal for us is this long, long period of pretty steady growth, pretty stable employment, pretty low inflation. We called it the Great Moderation. And if you go back in American history, before the central bank, we had quite a bit of volatility. We had booms and bust cycles through much of the 1800s into the early 1900s. Then the Fed was created to try to dampen all of that. We had a massive crisis during the Depression. We had a pretty good time with low inflation, but with 3 short recessions during the 50s. Most people, none of you really remember that. I vaguely remember, I've studied it. Then we had a big burst of quiet time, then a big burst of inflation. So I've just given you roughly 150 years of American economic history. The message, though, is the last 20 or 30 years, x the last 3 years, were an unusual period of pretty good growth, pretty low inflation, pretty moderate interest rates, but I will quickly say punctuated by some crises. So I'm not ignoring the dot-com bust and bubble or the housing crisis, et cetera. But those were, by historical standards, pretty well managed by the central bank. So I've just put out a lot of history at you, and the main thing to take from all of that is we have lived in a pretty unusual time without too much boom bust, good management of the economy.
To go from that 1980s long sleigh ride for 30 years, that just incredible decline in interest rates that all of us were like riding
Exactly
inadvertently, right. Not even realizing how much we were all benefiting from that. First of all, one problem is you'd have to have the pain to go all the way up there to the Volcker time
Right.
to begin with.
No, it's incredibly painful. Paul Volcker had to jack up interest rates to unprecedentedly high levels. Mortgages were 18, 19, 20%. The housing market was in complete shambles. Builders would sent into Paul Volcker 2x4s addressed to Paul Volcker, Federal Reserve Board. The language on the back was not appropriate for a Wall Street Journal Barron's audience. Chairman Volcker was kind enough to give me one of these 2x4s to remind me my job was to keep inflation under control. I still have it.
Wow.
They had to lock the Federal Reserve building because farmers came in and had demonstrations with tractors around the building. These are experiences that none of you really recall. And so, yes, huge amount of pain, long gradual decline, inflation under control, some blips along the way, not to minimize them. But we've been ultimately through a pretty good time economically, and let's hope that we can keep it going.
Roger, are the Fed's tools and is the Fed's mandate too blunt or too broad brush in that they don't seem to be able to address, and you've heard this, they don't seem to be able to address income inequality, say racial equity inequality, these problems that now some economists say that should be part of the Fed's mandate too, instead of just doing this to interest rates and, well, that benefits rich people more than people in need?
Well, certainly their tools are not targeted enough to deal with these major social problems. That is why we have monetary policy, we have fiscal policy, we have social policy, et cetera. Secondly, I don't think it's a good idea to burden one institution with too many responsibilities at the same time. That it just isn't going to work. I think the tools are two things. One is appropriately calibrated for the jobs we've given them, which is primarily inflation and keeping the labor markets at full employment, so the so-called dual mandate. The other point to make, though, is that their tools have evolved over time. And so it used to be simply, the Fed funds rate that they set at every meeting. I won't get too technical with you, but you, during your lives, you've seen new tools evolving. So the use of the so-called balance sheet, quantitative easing, quantitative tightening, these are new terms, and they represent new tools. I will do one more that's a little more technical, but paying interest on reserves. I won't try to explain what all that is, but basically banks have to leave money with the Fed, and for long periods of time they got no return. Now they get a return on it. And so the other thing that's happened is their tools are blunt, but they have been evolving as they've learned the tools that it takes to deal with these various crises that we've had in the last few years.
Right. We will have time, I believe, for some Q&A, so if you have any questions for Roger, store 'em up. Oh, not quite yet, if that's okay. Is that all right? We're going to keep going for a little bit, but I'm glad we got one. You're first.
You have to make it easy.
Right. Right. You're on the board of Alphabet?
I am.
I want to shift gears a little bit and ask you a little bit about technology and capital markets and where you see that intersection headed. I mean, there's a lot of questions about how things like AI, algorithmic investing. You're out there in the thick of it in Silicon Valley at these meetings, which must be incredibly fascinating. I'd love to be at an Alphabet board meeting. But just in terms of technology and the markets,
Okay.
how do you think they intersect?
All right, let me start with a really important disclaimer, which is I'm not speaking as a director of Alphabet.
I knew he was going to say that. Okay.
Then that means you applaud me for saying the right thing.
I'm neutral on it. Go ahead.
And so my personal points of view, and these that truly has nothing to do with being on the board of Alphabet. I've been in and around capital markets for quite a while. And one of the interesting things about capital markets is there are consistently new technologies, new financial technologies. What I think AI is going to allow us to do is synthesize and communicate massive amounts of data about businesses and the economy, et cetera, in almost an instantaneous time. Build hopefully much more insightful models of what drives things. But I don't think AI is going to be able to do the thing that drives markets most, which all of you have heard, which is sort of feed fear and greed, right? And so we'll all have the same data, and maybe models will be quicker and available to all of us. But at the end of the day, so much of markets, particularly equity markets, depends on storytelling and what you believe. And so even if you have a great analysis, you still may have different points of view about the future. And investing at the end of the day is taking a point of view about the future. For some people, that future is nanoseconds. For some people, if you're in venture capital, that future is 10 years. So having even better analytical tools will not help you understand the future better. They'll help you, by definition, understand the past more quickly. And so I'm an enthusiast for these new technologies for a variety of reasons. But I've also been in and around markets long enough to know that in the day, this is about human beings making judgments. And all of you know that because one of the things that we sometimes criticize, one of the things that we sometimes think is a weakness in markets is the so-called algorithmic trading that is purely driven by machines. And what you discover is if you have nothing but algorithmic trading, you potentially end up having more volatility. Doesn't mean that the algorithmic trading gets it right. And so I expect to see AI being used to do better analysis, et cetera. But at the end of the day, both short-term and particularly longer-term investment is very much driven by people's insights, and that's driven by, frankly, emotion as well as analytical capabilities.
I think a subject right adjacent to that point with technology and capital markets is regulation. And I'm curious, Roger, to know what you think about the optimal level of regulation when it comes to financial firms and to technology companies. How sanguine are you, for instance, at the balance that we have right now?
So look, when I was at the Fed, I was there for 13 years. I chaired the Committee on Bank Supervision and Regulation, so I was a regulator. Any of you know my history, and some of you, my wife was an SEC commissioner, so we got a lot of, probably, as my kids would say, too much regulation around the dining room table.
Wow, yeah.
Yeah, wow, that's a lot of
See that with
regulation.
your kids, that's a
Leave us,
burden there.
regulate them, don't regulate us.
Yeah.
So what do I know about regulation? What we know about regulation in this country is that the pendulum swings back and forth. You and I have been talking about that. And it is very hard to get the pendulum to land in exactly the right place. Why is that the case? Partially because markets and institutions change, right? So the kinds of banks that we have now, with the things they could do, they're both the result of regulation, but they're also unimagined by regulators, 100 or even 70 or 80 years ago. And so I am realistic about regulation. Regulation will try to catch up with markets that tend to move much more quickly. I believe it's really important to have individuals who have had market and real-world experience be regulators, because I think those people bring a knowledge and a nuance that doesn't occur if you're, exist only in Washington and away from the markets. But I also have to be honest, I don't think, I am realistic, and I don't ever think we'll get to the place where the pendulum will stop. It'll be just the right amount of regulation. Because if that's the case, it means that we probably haven't had innovation in financial markets or financial institutions and financial understanding. And so, I enjoyed being a regulator. It is a little bit of a game of catching up. And in some degree, the fact that we have such a vibrant financial system is one of the things that makes America spectacular. And if what that means is that regulators are playing catch up, then I think we just simply have to accept that as a reality. The other point I would make, if I can, is regulation is not just about what happens outside of in Washington. Having been the CEO of a major financial services firm, I also believe that self-regulation is incredibly important. And so, having a great chief risk officer, thinking through, scenarios of what might go wrong, having a CIO who exercises judgment and control, following some simple rules in terms of, if it sounds too good to be true, it probably is. There's also an element of what I would describe as self-regulation, which I think is basically good, solid management of financial institutions. And so I'd encourage people not to look just to Washington for getting the balance right, but here in New York, or wherever you think the financial capital is, you should be looking to the CEOs and the CROs and CFOs of major institutions to also do their job, to do self-regulation, so to speak, and not chase, bad ideas, et cetera, and not look for return without thinking about risk. So this whole thing about regulation is not just a political activity. It is what I believe CEOs, CFOs, CROs get paid to do on a daily basis in the financial services world.
And back in the day, if they messed up, then they'd be brought in front of you and Mrs. Ferguson. You don't want that to happen.
Well, first they'd be brought in front of the market, right?
Right.
Their stock would go down.
Yeah.
If they really messed up, then somebody would call them in and have a serious talk.
Do we ever have to worry about the federal budget deficit? And, people have been talking about that forever, but if you pay attention, it was 132% of GDP 4 years ago. It's now 122%. That's twice as much as it was 20 years ago, and, it was 30% 40 years ago. So is this ever going to come and bite us in the you-know-where?
What do you mean the you-know-where? Why don't you finish your question? Let them get off with
smart
the
guy.
you-know-where. What is that? So there are two separate things, obviously, the deficit and the debt. Interestingly, we have balanced the federal budget only 2 or 3 times since the end of the Second World War, and it was under the Clinton administration. I happened to be at the board of of governors of the Federal Reserve System, and we had serious debates about what we're going to do if the government keeps running surpluses. How are we going to run monetary policy? It seems so arcane now that we were worried about, surpluses as far as the eye could see. So, let's think about what this deficit problem is. The deficit problem has emerged from, by definition, spending more than the government takes in. Some of that is, by design, which is we have had a series of administrations that have reduced the revenue coming into the government. We call that tax cutting, without comparable reductions in expenditures. So, things are sort of set up
Right.
for a deficit. Second reason we've had deficits, obviously, is crisis spending. So some of the deficits have gone up quite dramatically during these crises that I've been talking about. Think about, the 2008, 2009, think most recently, about both the Trump administration and the Biden administration, deficits went up as they were fighting the pandemic. Some of these deficits are a little more complicated and nuanced because we are spending, the federal government is spending money making investments. And so we have an infrastructure investment or an investment in chips. And I think about those slightly differently, because if those investments pay off, it's the way you make an investment that will, improve the size, scope, scale of the economy. So the first point I make is think about where this comes from and think ultimately about the role both of policymakers and driving the deficit and other things. Now, having said that, we do seem to have an incredibly difficult time moving from deficit back to balance, much less surplus. So then that goes to, all right, if we're going to be running these deficits, we're going to be building up larger and larger debt, as you point out. Should we worry about it? We should worry about, I think, both of them.
Right.
The question, though, is, how should we respond? So as voters, you have to think about how much you want in the way of taxes, how much you're willing to expect your government to do. The debt side of it is actually much more interesting. They're both interesting, but the debt side is particularly interesting because most of our debt is not held by U.S. businesses or citizens. A fair amount of it is held overseas, particularly in China, but also as the reserves of a lot of central banks. We have what's called a reserve currency, so people hold their savings often in U.S. dollars. And as long as they're willing to do that, then we don't have to worry too much about the debt. The problem is one day they may wake up and say, well, we no longer want your treasury bills. We're not going to buy any more, and interest rates will spike. And so I would encourage us to take both of them very seriously. I think you start by fixing the deficit. And ultimately, I think the way we ultimately do this is we run an economy that's heavily driven by consumption and not heavily driven by savings. And if we could all rebalance a little bit and think about saving more and consuming less, then we will actually have an economy that runs in a much more balanced way, and we'll end up having the possibility of getting to a much more balanced situation in terms of the deficit, and over time, the debt will come down.
Okay, I think we're going to have to leave it at that. I'm so sorry. I apologize to you in particular. Maybe you can grab them out there.
Yeah, we can.
Is that okay? But we're really pressed for time here, and this has been fascinating to me, and I hope you guys enjoyed it too. Please join me in thanking Roger for.
Thank you. Thank you.